I'll share the screen right now. Let me move this away. Okay, today we'll be talking about Charlie Munger and lessons from it. As always, a very short disclaimer. Basically here we're just mostly for information and educational purposes, right? And please don't see it as financial advice on any of the stock that we talk about. Mainly, we'll only be talking about Berkshire today. And as a disclaimer, I do own it myself. And so let's get started. And thank you for joining us at the Premium Club event. So this is an invitation only event, and thank you for being part of our members. And so what we'll be discussing today, basically I break it down into just a few key areas, which is the life of Charlie Munger, and I'll tell you a few small stories and key moments in his life, and how I guess maybe that will be the key point where he formed some of his key philosophy and how he navigate through these troubling times. He actually have quite a rough, I would say, middle life, and quite a rough middle life, and how he overcame that. And then we'll talk about the starting of Berkshire and how instrumental he has been in creating the Berkshire today. And going deeper into a stock analysis of Berkshire itself, not something that we talk about quite often, mainly because every time we talk about Berkshire, it's the Warren Buffett company. It's a no-brainer. Everybody just assume that it's a great company. But this time around, we will dig a little bit deeper into the business of Berkshire and how everybody talk about the flywheel of Berkshire. How is it really set up to make it such a huge compounding machine in a way that in the top 10 market cap in S&P today, Berkshire is one of the few companies that is a non-tech company within that top 10 list. And how they have able to grow it from using mainly traditional businesses to compound the money as fast as some of these tech companies that are out there today. And then we will also have a segment where basically translate all that we learn from Munger and from Berkshire and formulating how we can create our own mini Berkshire at the end and create that own flywheel in our own way. And it's a great technique that I have been using it myself, and I have seen some success with it, and I'm still actively practicing this flywheel and this strategy, and hopefully you can see if it's useful for you as well. And then lastly, we'll just end off with our spin-off segment as well on some other things that I'll share with you, including some bonus material that I'll upload for you guys this week into the members page download folder, and you can access it later on. I'll upload it after this webinar. And finally, we'll end with just some small announcement as well. Okay, so the life of Charlie Munger. Today, when we talk about Charlie Munger, we always just see him as, the partner of Warren Buffett, the vice chairman of Berkshire Hathaway. And we assume maybe they have been partnering with each other for the longest time, since they're young. But in fact, they only meet each other in their 30s, and they only become partners well into maybe when Charlie was already in the 40s. And they both basically just led different life in different cities as well, but they stay in contact. And Buffett was actually the guy, which we'll talk about later, that convinced Charlie Munger to give up his already quite successful law practices and become a fund manager. So, number one, war effort. So, of course, Charlie Munger grew up in a time of war during World War II. So, he was actually in the army. but he wasn't in the front line per se, but he was so intelligent, so he was helping with the intelligence unit. And after the war effort, I guess maybe from the war, he feel that we should really live life to the fullest, right? I guess after some huge event, that's some of the revelation you might have to feel that you don't want to live a life that is you're going to regret. And so he wanted to do something big, and he went on to university. He worked his way, although jumping around a few schools, but in the end he went into to take a law degree, and if I'm not wrong, from Harvard. And then later on, he practiced law for quite some time, and mainly because law was his, you can say, a family business. His grandfather was quite a famous judge in Omaha, and of course, his father was also a lawyer, high-profile lawyer in Omaha as well. So they're actually from the same city, Warren Buffett and Charlie Munger. But after Munger graduated, he decided quite early on that he wanted to move away from Omaha and go to the big city. So he actually migrated to California, to LA, where he went into law there. But you might think, okay, someone that is extremely smart, extremely talented, went to Harvard, has a law degree, has a rich family, life is set. Life is set. But in fact, although he was working and earning good money as a lawyer, by the age of 36, 37, his marriage was falling apart. He has 3 kids at that time, 1 boy and 2 girls, and his marriage fall apart, and he gave everything to his wife. So all his asset was given to his wife, including the home and everything, and he basically went broke at age 37. Then he have to go about restarting his life. But just as he was trying to restart his life, his son got diagnosed with, I think was not really cancer, but with a life-threatening illness. And sadly, the illness dragged on, I think, for a few years, but it resulted in early death of his son. I think his son was only at around 10 or 11, I think. So a devastating event for anyone, right? As a father myself, I really cannot imagine what it would feel like. And he, from his interview, not to him, but from people closest to him, that most of the time when his son was in the hospital, he would basically have to work and then visit him in the evenings, and just after that walk home crying and along the way in Pasadena, in LA. So a very, very devastating event, and any one of us who have to endure something this horrific, most of the time we could maybe turn bitter to life, feeling that life is unfair, and maybe give up on life. But his perspective is actually a little bit different. He got over. You wouldn't say he got over it, but he decided that the best way is actually just to move on and not dwell on it. Right? The more you dwell on it, the more you fall into this hole of depression. So he decided to move on and then plow himself into work, and restart his law degree. And then after that, he actually ventured into real estate as well. And he earned, I guess he earned his first million in real estate in LA. And at the same time, because now he's a single father, and he basically needs a new wife, right? It's the 1950s. It's a socially mandated, I guess, to be married. And I don't know if this is true or not, but there's a funny a story that in order for him to find a new wife, and because he's such a logical person, he actually posted a listing on the newspaper, in search of a new wife for a divorcee. I don't know this is true or not, but he did come across his second wife on a blind date, Nancy Borwick, and very soon they got married. And in fact, his second wife Nancy was also divorced with 2 children on her own. So together with his 2 and her 2, the family of 6 started a new life together. And as he was just going through his 30s and 30s with his new family, rebuilding his wealth, mourning the death of his son, then an event, something happened in Omaha, which is his father was slowly passing away, was falling very ill. So he went back to see his family and also take care of the affairs. And when he went back, this is a time where a common friend between Buffett and Munger, I think the person was actually Warren Buffett's neighbor. When Warren Buffett went to speak to this neighbor to ask for investment for his partnership, because Warren Buffett was doing a partnership fund at the time, the neighbor told him that you reminded me of one person, which is also from Omaha, right? A very, very intelligent, very cocky person. So he said that you must meet this Charlie Munger. And in fact, it was a few years later after that meeting between Buffett and the neighbor that Munger came back to arrange for his father's estate, and they met. And although both wasn't too eager to meet each other, but they kick it off immediately, right? They spend the whole evening talking just to each other and not to anybody else. In fact, for the rest of the week where Munger was in Omaha, they met every single week and chatted more and more. This is because from the records talking of Warren Buffett, is because Warren felt that at the time, Charlie was the smartest guy that he has ever met, someone that is in the same wavelength as them, because we all know both of them are geniuses, right? They are geniuses, and I guess when they're talking to laymen like us, they will feel that there is a gap, right? There's something that I know that get grasped so easily that the others are not grasping. And Munger is the only one that's on the same intellectual level as Warren Buffett, and they kick it off ever since. And they stay in touch while Munger went back to California, and Buffett, of course, was running his partnership already at the time. And Buffett actually tried to convince Munger again and again that you're wasting your time doing law and doing real estate, right? You should be going into fund management and open your own partnership as well. And in fact, that is exactly what he did after a few years. And for someone who has never been in the finance industry, someone who has never really managed money for anyone, and in fact, he just started really getting more serious of investing after meeting Warren Buffett. So within that few years, he launched his fund in 1960s as well, and he ran it for, I think, for more than a decade. So you can see that this is roughly, let me just off this, sorry. This is roughly his track record from his Munger partnership compared to the S&P 500 and the Dow Jones. He drastically obliterated the index. In fact, he returned around 11 times the capital. And these are after fees, right? And these are after fees records compared to the index where just double in the 13-year period. But you can also see that his partnership is quite volatile. It can swing very, very drastically. If for someone that, if you don't really know who Charlie Munger is and you look at his record, you might think that he's kind of using leverage to boost up his return. But in fact, that's not what he's doing. What he's doing is he has a very, very concentrated portfolio. He don't believe in diversification, but I guess, as a genius, he's entitled to do that. And so in his portfolio, sometimes he can just have 2 or 3 stocks, 3 or 4 stocks in his entire portfolio for his partnership. So you can see the huge swing, but that doesn't mean that it's smooth sailing for him all the while. In fact, there are periods where, like in the 70s, where he endured 2 full years of very, very huge losses in his partnership. And that really make him rethink how he want to do his partnership, and in the end also make him decide to call it quits and then join Buffett together in helping him out as his right-hand man. So the life of Charlie Munger, if if you're interested to learn a little more, is really a life of a struggle. He changed his career multiple times. He has a setback in his family life. He has a setback in his financial life. But he always talk about, don't complain. It is what it is. Life is a struggle, and you make the best of it, and you journey on. And every event should be a lesson to you, not just the good event that happens to you, but also the bad events. And if you treat every event that happened to you in your life as a lesson, as something to take away, whether good or bad, it compounds your experience and it compounds your knowledge. So instead of just looking at them as huge investing guru who know how to compound their money, in fact, Munger believed that knowledge and experience can be compounded as well. And how we do that is just having a different way of thinking of life, a different way of treating every event as a learning lesson. What can you learn from it? How can you improve on the situation? Why did that situation happen to you? Why are you in the position that this event happened to you? And if you analyze that in a deeper level, you'll realize that sometimes everything happened for a reason, and you can find a way to learn and improve yourself over time. And if you have that kind of mindset as well, both to your knowledge, your life, your relationship, and of course your finances, everything compounds, everything becomes better and better over time. And when you look back, say a decade later, and of course we know that Buffett just passed away, and when he passed away, he was just shy of his 100 years old birthday, and in the last annual report of Berkshire Hathaway, Buffett actually put in, a tribute to Munger, and he called Munger the architect of Berkshire Hathaway, and this is quite true, and not just something that Buffett wanted to commemorate Charlie Munger, but in fact, when Buffett started investing, he learned investing from Benjamin Graham, his mentor, and his ex-boss where he worked for. And the whole philosophy of Benjamin Graham is what we call cigar butt investing. So looking at very, very cheap companies and he called it cigar butt investing is because it's sort of like walking on the street and you're finding a cigar butt that is already half smoked, but it's still alight. So you pick it up, it's soggy, it doesn't look nice, but still a few puff on it, and you can enjoy the cigar butt for a few puff. And that's basically the strategy of deep value investing that Benjamin Graham was teaching at the time. So they go about in the 40s and 50s to look for companies that is selling below their net asset value, right? Not just the net asset like what we view as book value today, but rather net current asset. So just using the current asset, the inventory, the cash on hand, and the account receivable, the amount on the current asset should be enough to cover all their liabilities, and what is left is considered the value of the company. And they're trying to find companies that trading even cheaper than this net current asset value. In the past, you can find it, definitely. Today, almost impossible to find it unless this company happens to be a fraud or a company that's going to collapse. So even in the later years of Benjamin Graham, he said that his strategy no longer applies, right? Because the market has become more efficient over time. But the strategy of Charlie Munger was working very well, and in fact still works today, which is buying great businesses at a fair price rather than buying fair businesses at a wonderful price. And this sets the tone for Berkshire. In fact, Berkshire itself, when Warren Buffett bought over it, it was a cigar butt investment, right? It's because it's a very, very cheap and cash-rich company. Warren Buffett bought into it. But using the cash that Berkshire has, or at least is still generating at that time, he pushed on to practice Charlie Munger investing, which is buying great companies that would grow and grow and grow over time and can sustain growth for a long period of time. And he focused, and using this mantra from Charlie Munger is what helped him build Berkshire from a dying textile manufacturer to what it is today. And you can see the performance of Berkshire Hathaway for the entire 60-year period from 1964 until the end of 2023. The full 60-year period when Buffett and Munger is in control of this company, the market return of Berkshire Hathaway is more than 4.3 million% gain, whereas the S&P 500 grew by 31,000%. So when we look at this S&P, it looks so little, but 31,000% gain it means that the S&P has multiplied 312 times, right? So it's doing a pretty good return over the 60-year period by just investing in S&P, right? Your money has multiplied 312 times at least over this period. But you can see that from this graph, the performance of Berkshire make the performance of S&P looks like a flat line. It's in huge magnitude. It means your money would have multiplied, let me minus 43,847.5 times over the lifetime if you've just bought Berkshire from start to finish. Not finish, but by the end of 2023. And all this really is the philosophy that Charlie Munger pushed to change in Buffett, and which helped create such a huge compounding machine. And when it got started, Berkshire Hathaway was actually just a textile mill, right? It started in 1888. It's two companies, Berkshire and Hathaway. And because the industry got more and more competitive, they end up merging to become Berkshire Hathaway. And when Buffett was buying, just as an investment for his partnership, it was just because it's a very, very cheap company, selling at net cash. So they bought and bought, but and when Buffett wanted to, when Buffett liquidated his partnership, he was left with Berkshire, and he wanted actually to sell off Berkshire, but because it's not a very liquid company, liquid stock, so he actually negotiated with the founders, and not founder, the main shareholder at the time and the chairman at the time, to sell back the share to him or to the family. But when the price was agreed upon, I think it was $11.50, but it came back at 11.38. They count in fraction at the time, and it angered Buffett, and he went the other way and bought up all the share that he can find of Berkshire and turned up to become the chairman of Berkshire and become the main shareholder at Berkshire, and they have boardroom struggle, and he basically kicked out the chairman and become the head of the company. And looking back, he said that Berkshire was probably the worst investment that he has made, because using the cash that he already has at that time and doing it directly, say buying the companies that he end up buying directly, he might have made more money without using Berkshire as a vehicle. But it also, because of Berkshire existence, it formalized his partnership with Charlie Munger, right? Because so up to that point, his partnership with Munger was more or less just I guess verbal partnership, and just being friends and sharing ideas with each other and helping each other with their deals. But the Berkshire actually formalized their partnership together. And after Buffett took over, he basically used the money and buy into insurance company. The first one that he bought was National Indemnity Company and National Fire Marine Insurance, which are now combined. And from there, using the insurance float, he started investing more and more and sort of leveraging what he got to what it is today. And the Berkshire of today can be split into 4 key parts, excluding the investing. If we take away the investing just on the operating side, I guess it's five key things. Insurance, of course, is a huge and most important part of Berkshire. They basically started out from insurance, and when the insurance company go out and sell their policy, they get the premium first, but they don't really pay out the claims so fast. And most of the time, they, by good underwriting discipline, they should earn a little bit money. And so while holding this premium and waiting for the claim to come, this is what called float. And for general insurance company, for typical most insurance company in the world, what they do is they will just hold this float in either very, very safe bonds or in cash management. Very, very few will even contemplate to go into equities. Even if they do it in a very, very small way. But Berkshire is the only one that do it in a big way. So the majority of the float, they still invest in equities. They can do that because, number one, they have very good underwriting discipline. So they never underwrite as a loss. Like even if the environment is they have to underwrite it as a loss, then they rather don't do the business. So they're very, very disciplined in doing that. And because the insurance company has been growing very, very fast, at that time. So they are always getting more and more premium. The premium size is always growing. So it's not a big concern for them at that time. And from that, they bought into many, many other businesses. The main one, of course, is energy. They're one of the largest independent energy company now in the US with Mid-American. Of course, also in railroad with their purchase of BNSF Railway. That makes them one of the 4 railroad operators and the largest one in North America. They also have a bunch of manufacturing company, from manufacturing houses, bricks, sports apparels, almost very, very unrelated, and also services and retail, right? Your Sis Candy is inside, your Dairy Queen is inside, Berkshire Hathaway property is inside. So they are actually one of the largest property agency in America. They are also one of the largest automotive second-hand reseller in the whole America as well. So all these services is under their services and retail business. And if you look at their latest operating income, they make around 37 billion operating income. This is only from their operating business. And you can see that insurance is a big part of it, from both insurance underwriting and insurance investment. If you add them together, maybe it's around 40%. Another 40% is others, which is mostly here manufacturing and service and retail. And then you have a 6% on utility, the energy business, and rail 13.6%. But of course, this number tend to change. And in fact, utility is considered low year this year. So most of the time it should be more than 10% over here. So these are their core operating business today. But what is most fascinating about Berkshire is this thing where they call a flywheel. And the Berkshire flywheel is how Buffett has created a system that allows him to keep recycling the money and compounding the money. So number one, Berkshire never pays a dividend. So, and he stated that he will never pay a dividend. Maybe after him, that could change. But for now, at least, never gonna pay a dividend. And so how they make this money compound is at the start, they bought into this insurance company, and the insurance company provide the float, where this premium that they hold on trust. So this is basically a free loan to them, right? This is considered a loan from the policyholder, but something that they don't really have to pay out straight away, and it's also interest free. So by using this money, they're gonna pump it into investing, and they can pump into a few types of investing. They can either invest directly in stocks, or they can acquire new businesses, and they have been doing both over the years. And when they go to acquire, they try to look for family-run business, at least from the start, because they were still small. They are buying a lot of family business that's just looking to sell, but still want to work on the business, right? Still want to have employment for the next generation. And in fact, this reminds me of one of these arrangement that I heard about when I was traveling holidaying with my family in Sabah. So we went to one of these eco resort in Sabah, where you have to take the river boat down into the kampong area, the villages. Deep in, I think we took about an hour and a half to 2 hours of ferry ride in and into a small lodge, eco lodge, resort in a way. And when we asked, how they manage this hotel, so basically the hotel operator is one person, and is someone from the city that has decided to do this eco resort, but the landowner belongs to the locals, so belongs to the village, and the villagers basically say that yeah, we can sell you this land, or we can lease it to you this land, provided you promise that you must employ my families and my offspring. So, which is why the hotels is still fully managed, mainly managed by local peoples, and they help them, not just giving them a job, but also upgrading them, right? Sending them to training on hospitality, training them to speak English, because most of the tourists is actually not locals, right? A lot of foreigners comes to the Eco Lodge just to see the nature of Sabah. So in a way, this is what Berkshire and Buffett is also doing, but in much bigger scale. He acquire family businesses, looking to sell, but still want employment for their family members, and this works pretty well. Most of the time, he buys maybe like 80% of the business and leaving 20% to the family in the past. But now, most of the recent deal he has done is mostly a full 100% acquisition from there. And then when he acquire already, it become parts of their businesses. As it grows, become bigger, it become a core business. If not, it will stay as one of the smaller subsidiary within it. But all this business should be profitable businesses that is cash flow positive, so Buffett doesn't need to pump in more money to save them or to maintain their operation, right? It's not a tech startup. It's a stable, money earning, money generating business. And then from there, the business can decide how much they want to keep for themselves, to reinvest, or also find more acquisition to bolt on to make their individual business bigger. But whatever left, right, after they justify that they did this much of capex for their own, whatever is excess goes back to Berkshire and goes back to Buffett, and then Buffett will then again decide what to do with this money, to invest again or to acquire more companies. And investing also, they split it into a few portfolio. Basically, the core holdings were holdings that they feel that when they although it's investing in a stock, but they really count this company as their subsidiary, right? So companies like Coca-Cola, company like Apple, although they own maybe 5 to 10% of the company, not big enough for them to consolidate the business into consider core holdings, but they see their holdings as these are our ownership of this operating business, right? So these are companies that they generally wouldn't sell and has been holding for a long time. But there are also a sub account managed by the two fund managers that is working for Warren Buffett, Tim and Tom, I think, and they basically both, I think, manage more than 10 billion each, more than that, I think now, and they are supposed to be the one that is going to take over the entire part of investing later on when Buffett pass, and each of the businesses is being taken care of. Managers that have been working for Buffett for a long time. Like insurance would be Ajit Jain, and the core business will be the next CEO, which is Greg, that will take over his entire position as CEO. So you can see that basically there's no wastage in their cash. Every time there's cash, Buffett knows what to do with it, where to find opportunity to let it compound. So the money is never wasted, and not be compounded, right? Being dividend out and being spent, or being new HQ or whatever. Right? Buffett is still at the same place that he's has been working for, since he was the chairman in QV Tower, and it's a rented office, right? They never built a fancy HQ for Berkshire Hathaway, and that's how they operate. So the huge flywheel that compounded into now close to $1 trillion now for the company is based on a few things, which is cash flow, find a way to generate cash flow, risk management to ensure that the entire entity is not at the risk of dying, right? Even financial crisis, they are one of the strongest entity out there, giving out loans and saving everybody, bailing out everybody. So a mentality and a culture of don't play with it, debt and having low debt, or how to play with that in a smart way, right? Because they use insurance float as a way for them to leverage their performance, and that's basically a debt that is zero interest, and they've pretty much have a weight on controlling it, and also by deferring tax, by finding a lot of capital intensive businesses. So because right now they are generating so much cash, the last financial year they generate $30 billion in free cash flow, and it's increasing, right? Increasing about 33% from the year before in 2002. So 2002 they're generating about 21%, 21 billion in free cash flow. This year, 2003 they generate about 33 billion in free cash flow. 31 billion in free cash flow, and this will all continuously increase. So how he can do it is by ensuring all these companies that is always growing their cash flow, risk management, and then they continue to invest in high quality businesses that will grow on its own without additional cash outflow from Buffett. And most importantly, when you have a good thing, when you have a flywheel, try not to disturb it and ruin the good thing. And before I go into how we can create our own mini Berkshire and create this flywheel for ourselves, I'll run through the standard analysis that we do for Berkshire Hathaway as a stock, and also looking at some of the key risks that you should look out to. Right? Berkshire is not without risk. So when I look at it, what is really the strength of Berkshire is, of course, number one, they have some economy of scale in some of their core business, be it rail, be it insurance, be it energy, right? They are quite big in each of these sector, in reinsurance, in energy in US, and in rail, and which allows them to continue to dominate that industry. But a key thing is also reputation, the reputation of Buffett and the reputation of Berkshire Hathaway. And Buffett actually talked about this. He has an interview, a speech interview, where he basically say that, you know, people ask, with hundreds of subsidiaries, how are you going to manage all of them? You know, how operationally, how are you managing all these managers? And he's basically said, this was quite a long time ago, maybe 10 or 20 years ago, but he's basically said that in Berkshire, we don't have quarterly meeting or board meeting, or, you know, with all the subsidiaries. All he has is that he said every 1 or 2 years, he sent them one letter. And in that letter, he explained that Berkshire Hathaway can lose money, right? So if your business lose money, it's fine. But Berkshire Hathaway cannot lose an ounce of reputation. He said the position that we have created for ourselves today is built on our reputation, right? That Berkshire is of high integrity, Buffett is of high integrity, and making deals that is fair, and they honor their deal. And this reputation cannot be disturbed, right? And it's only one time in the history of Berkshire that this is challenged in the debacle of Solomon Brothers. But that story for another day. But so from that incident onward, right, he placed a very, very high emphasis on maintaining the reputation of the company. And I think that is also one of the key strengths of Berkshire. So when they go out and make deals, because it's Berkshire, people know that they will honor honor the deal. And of course on financing, they are so big that they can have pricing power over the banks, over the bond market, in the time of, especially in the times of crisis. Weakness maybe on personality. That is, we always think of Berkshire as just Warren Buffett, and they don't have a centralized corporate culture. So there are hundreds of subsidiary. Each of them has is a decentralized model. So each of them would have their own culture, and it might create problems when Buffett is not around. So the threat, of course, is maybe it will break up sooner or later. Not the first year after Buffett passed, maybe 50 years down the line or 100 years down the line, it could and most likely will happen. Internal politics, we have no idea how each of these top guys work with one another, yet to be seen. And also capital allocation, because the key part, the central part of Berkshire is Buffett. He controls where the money goes. So when he's not around, will they still have that big finesse in capital allocation? Yet to be seen. But of course also opportunity, because there's always high quality business to sell, and Berkshire is one of the best places that you want to sell your business to if you want your business to still be around, still have a place in the world. And of course going international, which Buffett has already started doing these few years, and going into Japan mainly in a big way. And he did it in a very, very smart way by taking out huge debt in yen. So very, very low debt in yen, in Japanese yen, and then using that to finance his investment into the stock market. So addressable market. Today, if you ask me how should we see Berkshire, I would say that Berkshire, more or less, you can see it as its entirety, also like a sub S&P 500 by itself. It's a very diversified fund, you can say, which mainly track the US economy. And in a non-tech sector, right? Apart from Apple, the other businesses is really the traditional brick and mortar businesses. And so if you want something that track the US non-tech sector, Berkshire is a pretty good fund to look at, right? And of course also see it as a utility. In terms of moat, this is interesting because Berkshire, with so many subsidiaries, how can you define its moat really? I can't really think of one particular moat that it has. But overall, I think that it still has pretty good moat as a place where in its core business is mostly operating in an oligopoly, and be the insurance, even reinsurance, your rail, they're in an oligopoly, and also the reputation of Berkshire as the place to sell your high quality business to will attract, has some pricing power in the terms of deal making, right? If you have a good company that's being pursued by an ABC acquirer or Berkshire Hathaway, if it's up to the owners itself, maybe Berkshire will still win it more often than not. Okay, and I think this is the second last on Berkshire. But the risk, what can we not control? So basically, number one is Warren Buffett. His partner has already passed. We will hope that Buffett continue for many good years, but we have to be realistic. So what is the aftermath of after Buffett? Although he has said that everything is in place, his son will be the chairman. His right-hand man, Greg Abel, will be the CEO. Ajit will continue the insurance part, and the two fund managers will help him take over the investing role. That's all good in theory, but how well everyone will work under Greg is a question mark. And then when it comes to big acquisition, is it decided by Greg or is it decided by the two fund managers? So that one also can be a point of contention later on, because power can shift. He can say that, okay, all this decision will go to the two fund managers, but as a CEO in the future, when Greg becomes CEO, he has the power to change all this dynamic and all this decision making. So we shall see. And then on attracting talent as well, right? Without Buffett there, the top management, right? How well it can continue to attract high quality people who maybe just look up to Buffett and want to work for him. Without him there, would they still have the appeal to attract high quality talents? Okay. The financials we will take a look later on Morningstar, but basically the financial statement, I would say, really doesn't mean much, because it's a combination of so many businesses, and each businesses has different margins and different business model. When you're looking at the consolidated income statement or even the balance sheet, it basically means nothing, right? What we now do is mostly take Buffett words on itself when he explained how much that each segment is making, how much free cash flow the company is getting, and all that. So what's the best way to value Berkshire? I would say a way to do, I would say looking like maybe doing a discounted cash flow model on Berkshire, more or less irrelevant, because it's impossible for us to have an accurate assumption on this. Dividend yield, it doesn't even have a dividend yield. PE, because there's so many businesses inside, it can be quite volatile. In fact, the main way to value Berkshire is explained by Warren Buffett himself, which is basically he feels that the intrinsic value of Berkshire should be slightly higher than their book value. In the past, maybe when I first started investing, maybe 10 years ago, he explained it as the book value of Berkshire should be the intrinsic value. But over time, now he feels that the book value is still discounting some of the more intangible value of Berkshire, being the brand, being how good all their businesses is. So he feels that it should be roughly above a 1 times book value. And he has been buying back shares. At the beginning was at 1.2 times book value, that he will always like a backstop to the stock price, mainly because they have so much cash and they doesn't know, there's not so many big acquisition. Think about $31 billion a year. Every year is coming out 31 billion. It's basically, half of DBS or the entire Maybank. So every year you're buying one Maybank. There's just not so many companies out there. So a big part of that cash go back to buying back shares of Berkshire Hathaway. And he basically said that in the past, anything below, when it dipped below 1.2 times, he would just keep buying back his shares. He has raised that level ever since, slowly. And I think the last point of time where he keep buying back shares, Berkshire was trading at around 1.4, slightly above 1.4 book value. So that would be a pretty good range. 1.4, 1.5 would be a pretty good range of a fair value to Berkshire. So is it for you and me? I think if you are deciding to invest in Berkshire, one of the key things that you have to ask yourself is, Do you think it can beat the S&P 500, basically? So if you Berkshire is such a diversified company, you can just see it as a US focused fund, a non-tech US focused fund. And can this fund beat the S&P 500, basically? And if you believe yes, then yep. If you're not so optimistic about non-tech US, then maybe no, right? Or especially if you feel that the best day of Berkshire is over, after Buffett is gonna go into chaos, then it's not necessarily something for you. Or you, even if you believe that the US is in decline. So at the end of the day, your portfolio should align with your belief of the world, and so you will feel more comfortable with it, right? If you buy into something that is against your inner thoughts and your inner belief, then it's very hard for you to hold on to that stock for a long term, because anytime something negative happens, you feel the tension and you feel the unease that you're holding on this thing that you don't believe in, right? Regardless of whether your belief is true or not at the end, but to hold on to a stock because that's the only way that truly we can make some money in the investment stock market, which is holding stock for the long term. So to hold it for the long term, we have to believe in the story of the company. Okay. So thank you very much. If you have any question on Berkshire, let's not go here first. If you have any question on Berkshire or on Charlie Munger or on Warren Buffett, open up your chat box now. Time for discussion. And I can see that Wilson is saying that Berkshire is like an ETF. More or less, I would say. More or less an ETF on a US-focused non-tech ETF. And someone that doesn't charge you management fee. Yep, pretty good fun if you ask me. So until today, I'm still holding it, and I think Berkshire is still one of my top 5 holding, if I'm not wrong. I haven't checked my portfolio in a while. But thank you for joining me on this first 2 part. If you have any question, feel free to open up the chat and then let me know. And let me open up the next segment, which is our spin-off segment, which is sharing with you some of my favorite investment book. And in fact, it's not a book at all. It is Buffett letters, all the way from his partnership years, 1957, all the way until today, 2023. All this, I have consolidated them and also uploaded it to your members website. So your members page on this webinar, you will find the download link, including these slides and the Buffett letters all the way for the past 60 odd years. I'll throw in the Munger letters as well. So Munger is the chairman of Daily Journal, another listed company, sort of like Berkshire, that he runs, and he writes his own version of chairman letters as well. So you can see it on the uploaded page as well. And it's interesting to just read them in chronological order, and you can see how much Buffett slowly changed over the years, but also quite amazing how much that he didn't change, right? The core of his investing style, the core of how he does things is still very, very, very much the same way as what it is all these 60, 70 years ago. And then also understanding the value of money. And at the end of the day, I feel that money is basically just a game, and we have to understand how the game works the rules of the games and the rule of the stock market. And once we understand that a little bit better, then we have a better grasp to win in this game, right? We might make mistake along the way, but as we understand and play this game more and more, we will have a better understanding of how it works and how we can do it, how we can play it to our advantage. And then lastly, we're going to talk a little bit about how the strategy of this Berkshire flywheel can apply to us. Give me a minute. Okay, next one. So, okay, the next one is how how we can create our mini Berkshire. But before we go ahead, I saw a quick question by Victor. Nice to see you again, Victor. Thank you for the question. I'll read out the question. The question is, can you explain how Buffett mean of earning, owner's earning in a layman's manner? Right. Buffett has this term of owner's earning. And in fact, you can basically see it as just a sort of a proxy for free cash flow. So what he really means is taking the operating income, which is already the income minus all the depreciation and amortization and the taxes, and then using that operating income figures minus off all the capex needed for the business to run. So it's a proxy for free cash flow. Because for some business, the free cash flow, the operating cash flow can be quite volatile. So one year it can jump 50%, one year it can drop 80%, some year it become negative. But typically, the income, the operating income, the paper income tends to be more stable. So for a company that is still generating cash flow, the free cash flow, but maybe the free cash flow is not so smooth, it's a little bit volatile, a proxy for it is to use the owner's earning, which is by using the operating income minus off the capex. So you're using the operating income as a proxy for operating cash flow for the business. That's roughly the more or less the gist of it. But you should come to a similar conclusion if you use maybe an average free cash flow of the company over the same period, right? Thank you very much for the question. And update from Winston saying that the performance of S&P return is around 648%, while Berkshire has returned 1,614%. Is that over the last decade? Maybe you can let me know how was the time period for that. Yeah, but Berkshire has been outperforming the S&P 500 for majority of its history. In fact, I have a small bet with some of my friends. I think not too long, a while back, that betting on whether we feel that the S&P will return more or the Berkshire will return more over the period of time. And I can assure you I have lost that bet because I try to go against Buffett. All right. Okay, now going back to our segment, how to create your own mini Berkshire. So we explained a little bit just now. The ingredients of creating Berkshire comes down to having some place where it gives us stable cash flow, some place that the ability to invest into high quality stocks or businesses for the long term, a good form of risk management, to ensure that we don't die, we don't fall into financial difficulty, meaning the use of leverage should be very, very minimal. And then once we have that in place, don't disturb the system. Let compounding do its thing. I would say, let's look at the model first. Okay, and this is what I come up with for us. So you can see it's very similar to the Berkshire flywheel, but instead of Buffett in the middle, imagine yourself in the middle, and just you're the head of your mini Berkshire, right? You can see it as your entire family household income, or you can just on an individual basis. Regardless, you are Warren Buffett now, and your main job is number one, risk control, risk management, and control your spending. So you ensure that you have a stable stream of saving building up. And this stable stream of saving coming up, right? Of course, if you're not at that stage yet, I would encourage you to not look into this system first, but rather focus more on your personal finances to ensure to find a way that you have a regular saving coming in, either from by cutting down your spending or increasing your earning. It works both ways. And once you have that become your inflow. That become your key inflow on the cash. And as you build up the cash, you, as Warren Buffett, has to decide what to do with this cash. Not to spend on the new iPhone, not to spend on a new watch or buying a new car, but rather, how should you be investing this money? Or investing in yourself, upgrading yourself to boost your income, or investing into, say, a business or a side business for yourself. And say, focus on the investing part. You can build a portfolio up here, and I have been saying over the past few years, I think the best way to get started investing today is from ETF. And there's huge amount of ETF to choose from. And again, passive investing has proven that they're much better and much more cost effective than a lot of the active investing strategy out there. And so that's a good way to start, by building up your portfolio first. And then after that, you can consider, if you already have a special skill that you can go into a side business, or you have some property lying around with a rental income, your side gig, to increase and boost your income, to become have more saving in the end. Or maybe one day your side business can become a core business for you that will generate very, very consistent cash flow into your treasury. And this will become your flywheel. So you ensure that you are constantly thinking of your excess fund that you have, on how to best utilize this money, and not break the cycle. And suddenly seeing such a huge amount of money in your bank account or in your investment account, you realize that, hey, I can now spend on the one thing that would blow everything out, and you disturb the compounding, if you disturb the power of compounding. Not to say that you shouldn't spend on yourself or enjoy a little bit of your money, but I would just say that understand what truly makes you happy, what truly give you joy in your life, and just spending money on those that give you true satisfaction, rather than just chasing the things that society tells you to chase, right? A lot of things, actually, we might think that we want it, but actually, more or less, we are being bombarded by social pressure and by the product placement and advertisement that we are seeing every day, and the feel that we should have that as well. Or if peer pressure is a common one, where all your friends might have it. You want it. All your friends is holidaying in Japan. You should go to Japan too, right? So understanding that, having a core understanding of your flywheel, and a core understanding of what you need to have a happy and fulfilled life, and then just investing the excess continuously and not disturbing your mini Berkshire. All right. Uh, so I hope you enjoyed today's session. And if you have not been joining our last few sessions, I will also make an announcement that this year I have actually officially joined IFAS Global Market as a financial advisor. And I wanted to go into this business mainly. I wanted to try something different, which I see that the industry today is still predominantly focused on selling products, which is either selling you insurance or selling you unit trusts. But there's a lacking in building this flywheel and creating this whole process and monitoring this whole process for you, and truly understanding what is your financial objective in life, and also your objective in life and purpose in life, so that we can build your financing system around that. And so this is something that I wanted to do, and I spent the last few years really just analyzing and researching, both on of course on investing, on financials planning, but also on life in general, and to understand our motivation in life. Why do we do the things that we do? What is truly essential in our life, and what's truly important in our life? And we build our financial system around it, or build our financial solution surrounding it, so that we can live a more fulfilled life and a more peaceful life, and something that we don't have to work too hard and struggle too much for. So what I'm really proposing is, if this is a conversation you like to have with me, I really love to do just this 3-step conversation with you, which is number one, review your current status, both the stage of your life, the objective that you want to do, and also your financial status right now, to understand, and then look at ways on how I can help improve it, either to maximize it or minimize some of the things that you don't need in your life, and some of the financial products that you might not need in your life, and then building a more minimized and simplified but effective solution for you. And then from there on, be your long-term coach, and even help you monitor this flywheel that you have, and be a journey with you to build up your mini Berkshire Hathaway. Okay, so of course I shared this previously, but if you miss out on our last few discussion, you want to have this conversation with me, and I am very excited. If you would like to have this conversation with me, you can either email me, this is my IFAS email, or you can just WhatsApp me directly. In the next few days, I will also just build up a simple Google form and send it out to all of you, asking some basic questions. And if you want to set up a Zoom call with me, or just start a discussion through WhatsApp with me as well, I really look forward to that as well. And also, for Premium Club, we're gonna have another feature, which is I would like you to tell me what are the stocks you would like me to review. Can be a stocks, can be a fund, can be an ETF. You can let me know. So I also prepare a Google form. What I'll do is, every time after our webinar, the next day I'll send out this Google form for you to let me know what are the stocks or ETF or fund that you want me to review in the next webinar, or the maybe the next after that, because I might have already planned out what's the next 2 weeks webinar is going to be. But to the following webinar, you let me know what are the stocks you want me to review, and then once I got all the submission over the weekend, on Monday I'll list out the key ones, and then we have a vote on our Facebook group, and the winner by the end of the week, maybe not by the end of the week, if not I don't have enough time, but in the middle of the week, then I'll set to work on reviewing that stock for you. How's that sound? Okay, thank you very much. I really enjoyed this session. As always, talking about Buffett and Munger, I can talk for hours on the two of them. And before we head out, Victor, you have a comment saying that the rule of compounding, according to Munger, is don't interrupt it unnecessary. Definitely. And the question is, how do we have conviction to find a good quality compounder and a long runway? Well, the short answer is you don't know. But there is a way to increase our chances, which is always to look for high quality business, like Munger says. Because high quality businesses is, number one, very hard to go out of business. And number two, because their businesses is in high demand, there's a real chance that they will grow over time. And if they are being managed very prudently, not a company with very high debt, they would survive for a long time, right? For example, now today we talk about even a company like Microsoft or Apple. Do you think the risk of Apple or Microsoft going out of business is higher, or touch wood, but a company, a country, a small country like Cambodia or Malaysia can go into a crisis, into a huge long-term crisis? I would say sometimes the latter might have a higher risk than on those high-quality businesses, which are global in nature, and it's powering the entire civilization. So sometimes we can start with that. We can start with just ETF. And I am a huge advocate of ETF. I think it's the best way for us to get started investing in the most cost-effective way, and also as a peace of mind by just buying the S&P 500. There's something to take note of. And also another comment by Winston is iFast is listed on SGX. Yes, for those of you who do not know about iFast, is a financial company listed on SGX in Singapore. It's a Singapore company, and it's a Singapore company. The founder used to be a Malaysian, but of course it's now a Singaporean. It is one of the best performing stock in the SGX, listed a few years ago. In 2019, the stock price is $1, and as Wilson stated, the stock price is about $6.60 now. I think it went up to $9 something a few years ago during COVID. Yeah, it came back down a little bit, but still much higher than its beginning. Okay, these are our resources that we use for this episode and these slides. And as always, I leave you before we go with a quote from Charlie Munger. And this is a reminder that I always tell myself, and it's a good reminder on just creating a better life for ourselves, which is I try to get rid of people who always confidently answer questions about which they don't have any real knowledge of. And I'm sure you can think of one or two examples of such people who are just very good at talking and who just talk very, very confidently, and any question about anything that you ask them, they can say it like it's a matter of fact. but but you deep down you know they're bullshitting, right? And we have to try to not be influenced by just the confidence that people uh, portray, but rather trying to find out the answers for ourselves. And I think in life and in investing, always find the truth for yourself rather than relying on somebody else. Right. With that, I leave you to it. I really enjoy this session today, and I hope you too. As always, the replay of this session will be uploaded to our premium website, including this slide and also all the letters of Buffett and Munger into the download folder. So feel free to check it out by tomorrow. I'll have everything up for you. Thank you very much, and thank you for Winston for asking questions, and also thank you to Victor as well for your question. I'll see you in the next 2 weeks, but in the meantime, feel free to reach out to me on WhatsApp or on our Facebook group. I'll see you then. Till we meet again. Invest safely, guys.